Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. Today, we're just going to wrap up my exercise and look at the best online investment platforms that are out there. So we start with USAA, we went to T. Rowe Price, we went to Vanguard, Fidelity, Schwab, and then I threw in Betterment at the last minute just to see how they do, because they're a smaller firm, but it's certainly not anywhere near as large as those other five guys. But Betterment actually, I'm going to change the mic here. Betterment actually started the whole thing with a robo-advisor concept. And that was a Betterment and Wealthfront, whichever one came first, I don't know. But Betterment seems to have taken the lead among the two, Wealthfront versus Betterment. At the end of the day, it doesn't matter because they're just getting dwarfed by the big firms, Schwab and Vanguard in particular. But at the end of the day, Betterment's sole reason for living was that they said, we can invest much, much better in a tax-efficient manner than you hiring a professional advisor for, let's say, 1.5%. That 1.5% will be a huge headwind on your portfolio. You just aren't going to be able to outperform that. And so what you should do, the theory is, you should just invest your money in a robo-advisor. Just basically you're filling out what's called a risk tolerance questionnaire, and they're going to give you a model portfolio that you just say, go with it. And that made sense, except that most people still want a real live human being. They just don't want the artificial intelligence through an algorithm. They don't want to just be told what to do from an investment perspective. They still are willing to pay to some degree for financial planning services. Now, so Betterment has kind of in some way taken on the chin, and they've lost a lot of ground as Vanguard rolled out their robo-advisor plus services. Schwab has their robo-advisor plus services, where you can pay a pretty nominal fee overall scheme of things. We're talking 1/2 to 1/3, basically 1/4 to 1/2 of 1%, and you get unlimited people you can talk to, whether or not they're doing full-fledged financial planning. I challenge, but at the end of the day, you can't beat that. I mean, my goodness, you pay 1/3 of 1%. You have a team of CFPs at your beck and call at Vanguard, and you're using Vanguard ETFs, exchange traded funds, which have maybe 0.1% fees. You have all that for less than 1/2 1%. So that's Betterment's going to have a hard time competing with that. No other way around that. So I want to bring on Betterment because I like the fact that they started this change of investment strategy from paying some guy or some lady, like I said, 1.5% to manage your money to get a continual underperformance and to get tax inefficiency as well. It's just you can't. Those days are gone. I mean, obviously not gone, but they're going away because there's so much more efficient manners to do this without necessarily sacrificing a professional either. Now, for me, as a financial planner, I love the Betterment idea, the Vanguard, the Schwabs, the USAA, because you can tell your clients, let's go invest here. It'll cost you a nominal fee. You're not paying that to me, but then we can focus on the important stuff, which is financial planning. And as long as the firm that we're using has a methodology where they're diversified, and on top of that, they rebalance, and on top of that, it's ease of use, and we have a group we could call it to take distributions to change our mechanism and whatnot. As long as the structure is there, the logistics are there to get it done easily, seamlessly, we're going to be in pretty good shape from a financial planning perspective. So for me, I think it's an era of the dawn of a wonderful, wonderful new era. And I'm absolutely excited as we go forward to save clients money, especially if we're considering a lower investment return scenario going forward, because valuations, while not super high, are certainly not cheap. And so I think that's pretty good. So in this episode, I just want to tell you of the ones I looked at, which one I like best. And I got to tell you, bar none, is the Schwab. The Schwab Intelligent Portfolio is a robo-advisor. You don't get necessarily one-on-one financial assistance with the same person. You can call them up, don't get me wrong, but they're not going to give you any strategic advice, any retirement financial planning or anything like that. They're just going to give you investment consultations on your current portfolio. But I'm telling you, you're getting that for free. I mean, the advisory fee on that Schwab Intelligent Portfolio is zero, my friends, nothing. On top of that, you get Schwab ETFs, very well diversified across all asset classes, just for like 3 to 4 or 5 bips. That's 1/20th of 1% of a fee. That's amazing. The Schwab's Intelligent Advisory Services is 0.28. Same thing, and get the Schwab ETFs. But here you get a team of, I think it was certified financial planners that you can call for investment allocation advice, some basic financial planning stuff. Again, you're just not going to beat that. So all in is 0.3. And the nice thing about Schwab is it's a very well-known company, has lots of resources behind it. So they're not going under or anything like that anytime soon. They're never going to be, well, I'd say never. Most likely they won't be bought out by a big bank. I don't even want to go down that road. If you listen to my podcast, when I talked to Dustin Tibbetts from Jazz Wealth just the other day, we talked about what Wells Fargo is doing, and that's just not kosher. So hard to imagine Schwab doing that. The drawback with Schwab, I got to be honest, though, is they are a publicly traded company. So they're owned by shareholders, and I'm all about capitalism. Love capitalism without question. The drawback about a shareholder-owned company is that, unfortunately, in this day and age of mass market media, they have to, every quarter, they got to step up the table and justify what they did for the previous quarter. And if they don't, they're going to get their biggest shareholders going to be on them like white on rice, because the shareholders that run the most of the money, own the most shares, are typically other investment firms, and other investment firms want to see short-term gains, even to the expense of long-term growth, which is why Warren Buffett does so well, frankly. It's not because he's a genius. It's just he does it for the long term and doesn't sell every quarter because something didn't look right. And on top of that, he's got a lot of cash on the side, so he can deploy that cash when the markets are dying and people need a source of liquidity. Warren Buffett's at the ready for that, which means he keeps a lot of cash on the side. So Schwab being publicly traded will always have more of an issue in terms of long-term appropriateness than other firms. So there's no getting around that. Now, with that said, I mean, is that a huge issue? Not necessarily today. It's hard for me to see how Schwab's going to be profitable with this model. I mean, maybe they will be, but I don't see how it's going to be. And so what I mean, that's my concern. If they're not profitable and haven't gone through this with USAA, when they rolled out their wealth management division, and then they didn't get nearly as profitable as they wanted to, then they closed up the whole thing and left a lot of people in the lurch. And I have no clue that's going to happen with Schwab. I mean, you're talking $5,000 minimum to open an account with no fees whatsoever. You can't make any money in that regard. And for a publicly traded company making money, I hate to say it, but it's priority number one. Now, I think what their anticipation is, you'll start with this smaller portfolio that they're not making money on. And then as you build up, you'll start wanting more and more services from their financial planning team. They're separately managed accounts where they'll charge you, 1 to 1.5%, for complete financial planning. They can refer you out to some of their registered investment advisor RIAs that take on big, pretty large accounts, and Schwab gets a kickback on that. All that's on the up and up. But at the end of the day, the mass market, if they're the average account, let's just say is $25,000, and Schwab's not getting anything, but they still got to send portfolio. They got to send end of year stuff. They got to send tax forms, 5498s. They got to send all the tax stuff. Yeah, it'd be interesting to see how well they can maintain this profitability. I don't know. Hopefully they can, because I love it. I think it's fantastic. Vanguard is my second favorite, and the reason I like Vanguard is for two things. One, if you're doing it yourself, it's not quite the same as Schwab Intelligent Portfolios. Vanguard portfolios where you literally have to kind of figure out what you want and make those trades on your own, and that is intimidating to some people. No getting around that. From a cost perspective, a Schwab thing's probably cheaper actually. Schwab thing's even probably better than that. But from a pure, what's the word I'm looking for? The pure nature, I guess, of the investing. You just buy some ETFs that Vanguard recommends to, and I showed you that their model portfolios using their ETFs, and let's just say their average ETF is 0.1%. Yeah, it's a little bit more expensive than Schwab, but at this stage, we're talking pennies on the dollar, and there's no other fees. You just buy the ETFs, let it sit there. Every now and again, you go and rebalance it. The only drawback is that you have to do some work on your own, so a little bit of due diligence, not much, but some people just don't want to do that. And so because of that, that's why I prefer Schwab's. The Vanguard Advisory Services, it can't beat that either. I mean, that and Schwab's are neck and neck. And the reason I like the Vanguard Advisory Service is probably better than Schwab's. Now, I like the Schwab's Robo-Advisor the $5,000 portfolio doesn't cost anything in ETFs. I like that just because you can't beat that. No other way around that. The advisory services of Vanguard and Schwab are neck and neck. I kind of like Vanguard just because Vanguard is owned by its investors, not by publicly traded. It's not a publicly traded entity. In of itself, I mean, they got trillions of dollars of assets under management. So if old Josh with his $50,000, I theoretically own the firm. Yeah, I mean, I'm like an ant in one of those ant hills. They don't care about me. They care about the queen bee or the queen ant. So yeah, you own it, but at the end of the day, your ownership is minimal at best. So what's going to happen is the big players at Vanguard are going to drive the firm. However, those big players still own the firm, not as a publicly traded company with shares they can quickly sell and even short, which means they can say, we think Vanguard is being run incorrectly, so we're going to we're going to short the stock in order to profit if it goes down. And Vanguard, because it's owned by its investors, doesn't allow you to do that. So the advisory services of Vanguard are pretty stellar. I probably like a 50.1% preference to a 49.9% preference just because the ownership of the firm itself. But at the end of the day, Schwab actually, there are people you can see. They do have offices scattered throughout the United States. Vanguard does not. So, yeah, I mean, six one hand, half dozen the other in those two. So at the end of the day, Schwab and Vanguard by far and away my preference. I like the USAA one because USA is mutually owned. Essentially, it's a company that's owned by its members. It's not quite a credit union. It's not quite a mutually owned company, but it's along those lines. Again, they don't appease shareholders. You have to be a veteran or a family member thereof of a veteran in order to take an ownership stake in USAA. And so I like the USA robo-advisors. Everything else at USA I was not fond of. I think, I don't know. I mean, their do-it-yourself portfolio, it wasn't diversified, my friends. Is actually, I thought it was actually quite poor. I'm stunned that they're offering that. Their advisory services, their fees are just high. I mean, no getting around that. I think it's like 1.85 is the all-in fee. At least it was as of last year. I don't think it's drastically changed. And again, that online, that's financial planning services they offer. You get somebody. I don't know if that guy's even CFP credentialed anymore. And I don't know if you get the same people on a regular basis who gets to know you. It might just be whoever's next to pick up the phone. And that always bothers me. The robo-advisor area where you just, say, hey, you fill out their little risk tolerance questions. They say you should be a 70-30 investor. You say, okay, click here. They said, send us the money. You send them the money and you're off. That's pretty stellar too. So that'd be my third choice. And the choice between Schwab, Vanguard, and USA are literally within spitting distance. I mean, I'm not going to yell at you if you go wrong any of the ones. The reason I like Schwab the best is because they have more service offerings for sure. They got branches scattered throughout the United States. My big concern with USAA and then going on to Fidelity is that they're going to try to upsell you some of their, I hate to say it, crappier stuff. And so Fidelity and USA, they offer a wonderful robo-advisor tool. Fidelity's was free. I think you just had Fidelity mutual funds, which aren't horribly expensive in the least. I mean, that's a wonderful program. I just wonder if that's a loss leader. I just, in my mind's eye, I say to myself, are they doing this in order to get people in the door, and then they're going to try to upsell them later to some of their other crappier stuff? And again, just go back to the video I had or the conversation I had with Dustin over at Jazz Wealth the other day. That's kind of what Wells Fargo's doing, and I just that bothers me. And so USAA and Fidelity, their front door programs are wonderful in terms of they have these robo-advisors for just real cheap and not nominal necessarily, but cheap fees, relatively speaking, very well diversified, good holdings in there. But then the next step is just like going from wonderful to horrible. And I can't make those recommendations because if you got a call one day from, some sales guy at USAA or Fidelity and his salary is contingent on putting people into these more managed, more expensive accounts to you, I don't know. It does concern me. No other way around that. Especially, is there a reason we're going from the robo, i.e. the cheaper account, to the managed account? If the reasons for full-fledged financial planning, well, I know for a fact that you're not getting that. You're not getting full-fledged financial planning. You might be getting investment consultations, but that's it. You're not getting financial planning. And so to start with USAA or Fidelity, and they're wonderful, upfront programs, my concern right there is what happens later on when USAA and or Fidelity says, hey, or even Schwab. I mean, my goodness, I'm not going to discount them either, but they say, look, these portfolios aren't performing from a profitability perspective that we want. We really got to put our sales force into moving our clients into more managed accounts, which cost in USAA and Fidelity dramatically more. Schwab, not so much. Schwab, even if they put you in that, 28 basis points for a relationship with certified financial planners, that's absolutely worth it. The USA and Fidelity one, no, not for 1.7, 1.85. I think Fidelity said they start as low as 0.6. But for just a regular mass affluent person, say $200,000 in their account, you're not getting 0.6. You're not. It's going to be roughly 1.7. And I just, and I don't even know if that includes the fee. I guess the funds that they had within those portfolios didn't have any expenses. Now I think about it. So you're paying 1.7 all in. USA is about roughly about the same, and that's just going to be a huge drag on your portfolio. T. Rowe is fine. Nothing glittery there. They offer the T. Rowe mutual funds, very well diversified. Again, the only fees you pay are the expense ratios of the funds, and those are higher than Vanguard and Schwab's ETFs. 0.9. That's certainly not cheap, but it's not. You don't get billed, you don't get invoiced or anything like that, and that's sufficient. Sufficient, I should say. That's fine. So T. Rowe Price works just fine too. At the end of the day, all these firms offer something of value to anyone. Then I talk about Betterment. So Betterment, I like it. My concern with Betterment is just they're so small. I just don't know the staying power there, and because of that, it'd be hard for me to recommend Betterment over like a Schwab. Just Schwab has more staying power. Schwab can go to the capital markets to raise money if they need to. I don't know if Betterment is traded. I don't know how what their capital structure is. I just don't know. But because they're kind of small, they might be bought out by an aggressive mutual fund company who wants to establish more of a foothold. And again, my concern would be you might be getting a call as the end client. Hey, Mrs. Smith, we have these better portfolios for you. They cost 1%, but they're better. And you say, okay, if you think so, that's great. And my first question is, why are they better? Well, because you get full-fledged financial planning with our financial planners. Well, let's see. What is your full-fledged financial planning? What does that consist of? Because as we've seen with these other firms, full-fledged, i.e. comprehensive financial planning and real financial planning are not interchangeable terms. Their vernacular is quite different than mine, and mine is right and theirs is wrong. So that'd be my concern there. And again, that sounds a little bit paranoid. Well, I am. I've been in this business a long time. I've seen many an upsell strategy and many tick me off, to be perfectly honest with you. All right, so that's my recommendation. So I'll start with Schwab, by far and away the best. By far and away. The best, in my opinion. Vanguard is a close second. Fidelity and USAA, well, I'd probably go to Schwab, Vanguard, the first tier. Betterment and T. Rowe probably in the second tier. Fidelity and USAA in the third tier. Depending on what you're going to do. If you're going to just use the robo-advisors, Fidelity and Vanguard would be in the second tier, bar none. But again, my concern would be the upsell concept. If you're just using, if you're willing to pay a little bit more, T. Rowe, Fidelity have, T. Rowe, I guess it would be Fidelity have decent ones. Yeah, I just still got to go with Schwab and Vanguard with probably Betterment as a it's a tough one there. Schwab, Vanguard, I just think that's the way to go. All right. Well, I hope this whole series has been helpful. I've enjoyed doing it. I've learned a lot actually myself. As remember, this is May 2018. Things change all the time. I mean, the big, again, these are just online retailers. I haven't talked about Morgan Stanley, Merrill Lynch, and all those guys. And at some point, maybe we'll get into that, but I doubt it just because they're still good old-fashioned brokerage firms. So I'm not probably going to go down that road. But if you want me to, I'd certainly be happy to. But I hope it's been helpful. I've learned, and I hope you have too. Don't forget to subscribe down below. We've got lots of other things to talk about going forward. Give me thumbs up. Thumbs up are always helpful. And then don't forget to hit the notification button when you hit subscribe, that little bell, so you'll be notified of future content here on the Heritage Wealth Planning YouTube channel. What you can see, dude, by the way, and this is the right here. You see, these are my playlists. So if you go to Heritage Wealth Planning, these are all my playlists right here. So review of online portfolio tools, got investing playlist, all my like videos, retirement planning, how to reduce taxes and new tax law. I don't know why only one's showing up. I got 2 videos there. Taxes are one thing I like quite a bit. And I think I have my 21 reasons you need a Roth. I'll be doing that a lot more. I've only done my intro video on that, but I will do that here shortly. And then 8 ways to get your financial house in order is the book I just published. So you can follow that as well. But this will probably be my next one, 21 reasons you need a Roth, is I'll focus that on my next series. So look forward to seeing you next time on Heritage Wealth Planning. We'll see you later. Thanks, guys.